You may not remember it now, but you were pretty hot to see me back then.
You weren't so lukewarm yourself, at least at first.
It fizzled, baby. That's the way it goes.
Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend Podcast. Today is Friday, October 7th, 2022. S&P 500 currently sitting at 3648. I'm David Zarling. I'm here with Ian Equity Curve McMillan. Quite the bit of information this week, Ian, to say the least. Where should we start?
Quite a bit of information in both directions, which I guess has been a more common theme this year as far as volatility and, multi-day moves up and then quickly followed by multi-day or big day moves down. And that is once again what we saw to kick off October.
For sure. Right. Last trading day of the month of September was last Friday. Closed at new lows for something like the S&P, a bunch of other things. And by Monday morning, you had stocks were ripping. You had almost a 90% up day on Monday, greater than, and what I mean by that is 90% of stocks in the NYSE participating to the upside. Same thing on Tuesday. So you had back-to-back pretty bullish breadth or expansion breadth type days.
Yeah.
Consolidation.
Dave, did you know it was the biggest move ever to start in October?
No, I didn't know that. Not anymore.
Yeah. So, yeah, it was, and there were, I'm going to be honest, FinTwit was giddy. They were giddy on Tuesday.
Well, there was both, I sense, just from, and, Twitter's Twitter. We also know that we've got a fair amount of internal sentiment regarding pain. There's many people that just want to be out of the market.
People are ready for a bottom. And I would say the evidence was there. There were reasons to get involved.
Oh, for sure. We got involved because of reclaiming. That was our game plan above 3667. And with the divergences we saw across the board regarding
the failed breakdowns, and there were some good things. I thought this was the best chance to rally that we have had since, from a breadth perspective, our participation perspective, since the June, July. It was and you had a good risk reward levels.
No, that's really what it comes down to, is managing risk versus reward. Nobody knows a bottom until afterwards. All you can do is manage risk and identify supply and demand equilibrium levels, so resistance or support that you can manage risk against. And in this particular market, using something like the S&P 500, that level was 3667. Yeah. And if you could reclaim that with certain characteristics, recipe ingredients, such as breadth expansion, which we saw on Monday and Tuesday, like you said, that was a setup for a potential bottom to be put in. We wouldn't know that until later, but it's a level, right? Because if you're taking on risk, but you're only 1% away from that level with the potential of 15% from there, that's 15 to 1. And that's like swinging at a 2-0 fastball. It's worth it.
If you're towing the water on that.
Yeah, right. It's worth taking that risk, because eventually there will be a bottom. Eventually there has to be some market structure that will support that bottom. Not all bottoms are V bottoms. And now,
however, this one different than the early September. That was over a month ago. I don't really remember showing too much interest in that as far as portfolio movement.
No, in fact, we exited out of that move, meaning the 3 or 4 day breadth expansion move, like 6th through 12th.
Well, we exited out of our short positions.
Well, yeah, but we also exited out of some long positions there too. And that's been this type of market is we've seen how many 90% up days that then get followed by 80% down days.
And
So
they
that
just get slapped so hard. I believe I shared this stat last week, maybe. We almost got it again this day, which would have been the fifth, or this week, which would have been the fifth time this year, which is an insane amount for the statistics, but a 90% up day followed by an 80% down day. Yep, almost had it. Or I'm sorry, an 80% up day followed by a 90% down day. I had those two switched.
okay.
It's already happened 4 times this year. If today had happened Wednesday, we would have got there. In essence, can you say it was pretty quickly followed by another bad breath day? Yeah, I would put it in that category.
Well, for sure. I think the information we got this morning from the market was back into guilty territory below 37.85 on the S&P. And the 3667, we're below that right now. So the downtrend thesis confirmed. With the upside potential bottom thesis, a tactically bullish scenario, like you said, got slapped. That thesis got slapped. And it's notable.
We were right for a while. And then
Well, right. And the consolidation midweek needed to hold and move higher. I mean, we were on the verge of something called a Whaley breath rush, which does have statistical significance, but that also failed. And it's mathematically impossible now to have that happen. But that's happened at major bottoms before, such as the COVID crash bottom had a Whaley breath rush coming out of it.
So you're saying even with like 100% up day, we couldn't have gotten it?
No.
Isn't that fascinating?
Right. It is fascinating.
To know that Wednesday and Thursday, just again, to use mathematically did not lead to enough follow through off of Monday and Tuesday where this would trigger. And like you said, it is,
it's like the team that
significant, not immediately, but when you look out weeks and months, Whaley breath thrusts are pretty solid indicators of incoming demand in the market.
Yeah, for sure.
So to have such a great opportunity and for it to fizzle out once again, I think is so 2022.
I was just going to say what we're also confirming is the character, right? We always talk about the character internally of the market. It's one of the things that allowed us to exit something like end phase at an appropriate level because of a character.
Yeah.
Right. Before, correct. And it was actually, I don't want to get caught into what day it was, but all I know is, and I give Pratty credit, identifying a character change.
Like, hey, this is not working.
Well, meaning, hey, end phase is, the market's weak, but end phase is getting bought each morning. And then there's a morning where it doesn't. And this is, to your point, we've seen how many 90% upside breadth expansion days only get slapped back down.
And it's 80% lower from that.
And that's right.
Or 18.
Right. Right. And we continue to see that characteristic where we have these short bursts of breath. And maybe we look back 6 months from now and there is some type of bottom that happens here, right? Because it's really about being above 3667 on the S&P. And, I don't want to get too caught up in one index, but it's one of the best indexes on the planet.
Yeah, I think it's the easiest one for people to understand. Is the market in an uptrend? Okay, you're looking at the S&P. No, I agree. The kind of failed breakdown level there, I'm still, my line in the sand was more the 3,700, which again we got to, and then of course we bumble around. Looks like there could be some accumulation going on because it holds up nicely. And then this morning breaks in. So that thesis is done. And
right.
We'll see. Yeah, you could absolutely, I agree with you. You can still continue to build
A base down here
basing bottom. Yeah.
could absolutely happen. What's interesting this week is, from a character standpoint, this current correction that we're in was a correction that also was accompanied by falling treasuries, rising rates, rising dollar. And we saw that also confirmed this week, that ongoing characteristic, right? Because treasuries, 30-year treasuries are close to going out to a new all-time low, or not all-time low, recent low that goes back all the way to 2013. And the dollar continues to hold up well on a trade-weighted basis. But one theme that we saw earlier in the year that cooled off over the summer that appears to be returning, that might provide opportunity, and that's not a recommendation: energy.
Energy seems to be back. Crude dips below $85 for a little bit, which is the highs. That was a big behavioral high from a year ago. So last like late October, early November, we got to 85, sold off, most of Q4, went into Christmas down at 65. That led to the big rip up to 125. But we spent, like you said, most of the spring up there, and then June, July, August, September, 40% drawdown, but back above 85, big level. And yeah, energy stocks, as you would expect, they like it.
Well, and how much information is it that now we have a little bit till close, but how much information is it that we would have energy hold up in a tape like this?
And it continue, right? So what? It's right. I don't know if this is true. I know for a long time it was the only positive sector year to date by like a mile. Like I know at one point it was up like 40% year to date. XL, I think we're using XLE. I'm sure it's absolutely still positive for the year. But yeah, I mean, you had multiple names. Again, from when we look at from a technical perspective, and what are the major indices doing? And not just about performance, Dave, but about, did these names take out their June lows? Or how quickly did they recover back up above, their equivalent of the 4180 level on the S&P, and they held. So not just performance, but under the surface, when you go and look at the charts, there has been what appears to be, and now we're coming on the other side of it, accumulation that happened as the market has continued to sell off.
Right. It's a valid point. I think anytime you've got a situation where something holds up well in a down tape, that's information, but it makes you wonder how long that can last.
Well, I know that energy also sported a pretty big, it's one of your favorite patterns, but a pretty big reversal this week.
Oh yeah, another island.
Yes.
Another island, yeah. We're
right through that kind of like 73 to 75.
Yeah, well, and that was right below a 200-day moving average. When you pull that data up, there's this little consolidation that happens underneath the 200-day moving average. So there's a gap on using something like XLE between the 22nd and 23rd of September. It creates this price gap to the downside, consolidates for a few days underneath the 200-day moving average. It does look like energy is going to be also a victim to selling pressure at this point. But yeah, like you said, reclaims that important 72, 73 level, gaps above the 200-day moving average, and hasn't looked back since then.
And I think 80, when you go out long term on a weekly chart, $80. And I've said this a couple times this year, and I put kind of Exxon Mobil above, and it's been choppy around here, but that's the market we've given. But Exxon Mobil, if it's above its March 22 highs at 90. I want to say it's like 91-ish, 92-ish, off the top of my head. But again, we moved back up above there this week. Can we come back again? Sure. But it continues to be a strong move.
Well,
And many stocks in the energy sector already had new highs before. I mean, just as this was starting.
right.
There were a few stocks out there that didn't take them too long, and they were, I mean, held up very well.
Well, and how many years have we observed, right? Because I always say we're market historians, where the strongest sector going into Q4 ends up only getting stronger. And energy is one of those, right? Energy is, I think, the only of the major 11 that's positive year to date.
Mm-hmm.
And are we going into Q4 with energy just going to own the day through the end of the year? Right now, it's one of the few things with a rising 200, rising 50-day, and rising 20-day moving average, like you said, with the majority of stock. Well, I shouldn't say majority, but there's a fair amount of energy-related stocks breaking out to new highs.
So utilities were positive until about 2 weeks ago.
Right.
That's another name that has gotten, or another area that has gotten absolutely destroyed.
Right.
And I can make that into a bear case, and I can make that into a bull case.
Yeah, you could do either one with that. But
it's an interesting, and they're continuing, and they look horrible today.
Well, and destroyed is a good word, because you're talking about minus 18% in 3 weeks.
They've got to be. So if you go back,
and those are
over the last month, your worst two sectors are utilities and real estate.
Right. And two pretty interest rate sensitive areas.
Yes.
And so is that confirming back to something we talked about a few weeks ago? Why are people trying to pick a top in rates? Until we see that abate, we continue to see rates move higher in an uptrend. 30-year treasury bond yields are close to going to new levels that we haven't seen since 2013, near 3.8. Almost 3.85.
Yeah, and I mean, we're right up here at, if you look at the 10 years close.
Yeah. And so it's interesting that, and this goes back to talking about the 60-40 portfolio, 60% stocks, 40% bonds. I mean, this is one of the, if not the worst starts to a year or year-to-date returns for that portfolio. You've got,
I think, the worst since, I saw this stat yesterday, either 31 or 29.
Yeah, so it's
19.
Yes, correct.
And I'm sure that had to do a lot with the fact that stocks were down 70-80%.
Right, stocks were down big, 10 years weren't down that bad. But this is a case where this is the worst it's been for bonds in the 60-40 portfolio, basically since the early 1900s.
I will say there has been no toe dipping in bonds.
No.
Us.
No. And at the same time,
continue, right? Junk. And those two things, if we go back to a couple things that didn't, so this equity move higher, there were a couple clues. I'm so glad you brought this up. There were a couple clues from the fixed income space in that high yield bonds never reclaimed. They never had a failed breakdown. And CCC credit spreads have continued to just zoom higher.
Right. And credit spreads, another way to view that, when they zoom higher, that is tightening liquidity. And tightening liquidity is not a positive backdrop for upward moving risk assets, whether it's a junk bond or an equity.
And it doesn't mean it happens right away. I mean, it takes years, it takes a long time for ripple effects to happen. I mean, I think we've seen the effects of it already on the fixed income and the high yield market this year. But there was really no demand there, like we saw the last few days, or at least, in this recent rally out of equities. And I would say another risk on asset, Dave, that continues to have really lethargic bounces is Bitcoin.
Yeah, that's true.
Like there's just, again, and I say this from, people talk about, oh, Ian, let's move from 20 to 24,000. And I get the percentage moves. I'm going to say, that's beta there. But
wait, there's beta in crypto?
There's a tidbit.
I didn't know.
So yes, it can have 5-10% moves when stocks only move 2-4%. But again, when we talk about levels and is this asset above this level, again, if we want to talk about the S&P and June lows or 4180, it has this entire year has continued to just bumble around. And I feel like it's just waiting to snap these highs around, we'll call it 19,000.
I was going to say, I mean, to me, you look at a chart of Bitcoin and the 18,340, you break that. And we've talked about this in the past. You're now targeting like 10 to 12K on that.
Easily.
And so your point is valid because the demand outpacing supply off of that 18.5 or that 18.340 level, pretty anemic. Not really a lot happening from a demand perspective. And so you go into another weekend where maybe there is something happening in crypto land that takes us another big leg lower. And there'll be opportunity there again, but there's no need to be involved in a massive drawdown, right? Because the difference between minus 80% and minus 90% is minus 50%. Like if something's down 80%, to get down to minus 90% takes another minus 50% move, which is something, we've seen in other equity spaces, whether it's, like marijuana stocks.
Yeah, that was shorter than the game yesterday, but
yeah,
well, I'll learn.
There's plenty of places that are down that big, and they didn't abate.
And they continue to be, and so we use that again. I say what I said earlier facetiously, but it was another great opportunity. That just one of the worst asset classes over, not during just this bear market we're going through. I'm talking about like years, these things. And they were up 15% yesterday, something crazy. And down, if we're going to use an ETF, so we'll say that the whole space was up and then right back down today. There's just no follow through. And that would be an area, if we were truly in a risk on environment, you would expect to see.
Yeah, I would say crypto assets, cryptocurrencies are risk on when they're moving up and risk off when they're moving down. And they didn't have when you look at this week, the positive development from a bullish, tactically, and let me clarify what this means. Tactically bullish within a bearish thesis would be similar to saying, hey, this team has taken the ball on their own 10-yard line and driven to the 40 with some pretty impressive plays. The idea that they could score a touchdown within a losing game is possible.
For sure.
But within that thesis, however, you likely would have seen characteristics such as bonds show some demand, dollar show some weakness, crypto see some demand. And those last three I just said didn't happen. You had the equity breath thrust, but you really saw anemic moves and opposite of it, like even worse than anemic, out of something like treasuries. Dollar held up really well. Cryptos look puke-tastic. We'll see. As long as they're above that 18.5 level, should be okay. But that's under assault. Those are clues.
I think they're absolutely clues. I also want to say, Dave, I think that it's awesome that you've got to have borderline decent knowledge of football to understand our podcast. I think that's pretty cool. And I don't think we should change that.
No, and
Or at least when it comes to our analogies.
no, well, and here's the deal. Competing at a high level is an important part of life. And sometimes you're competing against yourself and your mental state. Sometimes you're just grinding because maybe you're exhausted, but you still need to be that dad each night. Sometimes you're actually playing a sport. But let's be honest, markets are the most competitive arena on the planet.
Yeah.
Like, do you know how many people
only
we
arena
are
I know where there are trillions of dollars being moved around every day?
by smarter people than me?
Way smarter people that went to way better schools and have way more resources.
Right. And so our edge is technical analysis, is charts. That's the equalizer for us. It's really, right? It's pretty easy for me to be an option quarterback, take the ball down the line. If the DN crashes, I pitch it. If the DN takes the running back, I cut it upfield.
Yeah.
Same thing above 3667 on the S&P, we could take some risk. But once that fails, we're out.
I think we pretty much run a triple option offense.
Yeah, it's RPO. It's run pass option, pretty much. But it's in a competitive environment, and it involves money. And so, what's your risk management process? That's a huge part of it. It is buy and hold a risk management process? No. It's just saying that you always think markets will come back. And I've seen that a couple of times this week where people are like, well, even if we correct another 30%, this market will be back. I don't know how we know that.
I don't know what. Okay, here's my question: what is back? Is that 2 years from now?
Right.
Is that 7 years from now?
And are you 20-year-old? Are you 20
I think
years?
people forget a lot about, right? Most
The
technicians will tell you the bull market that we are now, I would say we are most likely coming out of, didn't start till 2013. I don't care about 2009. From a technical perspective, it didn't start till 2013. Because that's your break-even point,
Right. Yep.
from the 2000 and the 2008 highs.
Which that was an 18-month correction.
And so then there's the argument, was 03 to 07 even a bull market, right? I mean, there's that. From a technical perspective, you could make the long-term argument that it wasn't, and that the new bull market didn't actually start until 2013. Now,
Well, and that's the camp I would be a part of, because
were there bull markets in things like bank stocks and like obviously yes. But if you don't go anywhere from 13 years,
yeah,
it's hard for me to believe that there was a bull market in between that.
correct. And when you start out with the concept of time, right? The 2000 to 2002 or 3 bottom, right? That's 2 years down. It took 5 years back up. Then you had a correction 0809 that was 18 months. That then took 4 years, 3 years to get back. And there's a big difference between being a 20 and 30-year-old and depositing money, dollar cost averaging in to that environment. And there's a massive sequence of returns risk for retirees on withdrawing out of that environment. And that's where I think many people miss the importance of risk management, because if you're taking withdrawals out at 50% lower, that also is compounding. And that's why you have to have,
stops at 50. And again, that's for indices. These people, the individual stocks, as Mark Minervini loves to point out, we talk about the index, the NASDAQ going 80%. I mean, that's just the average. That's just 100 stocks that went down 80%. Think about the other 4,000 and what some of those can do.
right. Well, and we know that, right? Because we have some data on the average retail.
I look at the same data every day.
Right. Well, and the average retail account is down almost 40. And we've run into individuals where, from a prospect standpoint, it's at that point really hard to hit the sell button. And that's hard. It's an emotional.
And bonds have also been a big part of that for people this year. I think that's what's made it especially hard. Okay, stocks are down 20%.
But
your
stocks.
average investor probably rolls their eyes at that because, oh, okay, this happened to me 2 years ago. This happened to me 4 years ago. Gosh, this happened to me, early 20. I mean, we've had some 15, 20% drawdowns over the last 5-7 years.
Well, and you're using the S&P.
Yeah.
Like when you look at the average median stock, it's down bigger.
Well, yeah, you want to pull up the NYA or value line. Yeah, so you're now, value line. We're at the January 18 blow off top.
Yeah,
So
that's incredible.
4.5 years where the average stock, if you had just thrown a dart at a dartboard, the average stock is flat.
Yeah. So, and really what's going on here is this goes back to the podcast we did on Remember the Titans. It's the big guys that have held up the NASDAQ 100 and the S&P 500. When you look at everything else, when you take those out, it's carnage. And it's carnage that's been going on for over 18 months, really. The average stock is down way more than 20%. And the S&P and NASDAQ look the way they do because they have things like Apple and Microsoft in them that are historically high levels from a concentration standpoint of the index.
And those are still the only, I mean, you've lost your other big, you've lost AMD, you've lost NVIDIA, this week you lost Tesla. Well, more intermediate term on Tesla, longer term on the others.
Well, I don't know because
Tesla still needs to break 200 or 205.
Yeah, but this is happening below a falling 200 and falling.
Oh yeah, no, it's bad. And the evidence is on the side that it gets there and breaks it.
Well, and do we look back because wasn't it 2 weeks ago that Apple showed its weakness, and now this week it was Tesla? And those are two pretty big. And previous to that, we had talked about Microsoft, Google, and Amazon, which had already kind of started anywhere in the fourth quarter of last year. Now we're seeing Apple and Tesla break. And those were kind of the last two pieces. Now, I don't want to sit here and say it's over, but Apple's week last week on a relative basis and then follow through this week, if those two go, it's going to be really hard.
Look what they did to Microsoft.
Right.
Gap, consolidate. You want to talk about an island? Look at the Microsoft.
Well, and that's okay. That's a great point because you're talking about one of the most liquid stocks in the world, and you get an island.
This is the second one. Remember the island from early mid-August?
Right. Like that's pretty to get an island. And again, for those who don't know, an island is you get a gap over a certain price level, meaning there's no trade that happened there. Price consolidates at a certain price level, then gaps the opposite direction over a price level. And here we have Microsoft gap below 245.
Yeah.
That's a big stock. And that 245 level just happens to be the volume weighted average price going back to the COVID lows.
And you zoom out, it's a huge, you go back, it's the June, bulls fail. Again, maybe we are sitting here, it's 2:15 Eastern. Maybe they rip this 3% over the next couple hours. But to me, this seems like I said earlier, very 2022, yet another.
They fumbled it on the 40.
Yeah, maybe they may have even. I wouldn't say they're in the red zone. We didn't get above, maybe the red zone's the 200 day. But
no, they had a drive initially. They converted
they were
2
on.
first
They had
downs.
good field. And here's the thing: they started off with horrible field position. They started off inside the 5,
right? And they converted
got
2
it all
first
the
downs.
way. And we saw what we wanted to see. We wanted to see him hitting the perimeter. We want to see running backs, hitting the holes that the O-line was creating. And then we get to the 40 and they botch the handoff.
Right.
D lineman falls on it.
Yep. That's an appropriate analogy of what we saw this week. Monday and Tuesday, super positive, reclaiming important levels, breadth expansion, the things you'd like to see out of a bottom if it's ever going to turn into one. And
Like
subsequently,
watching that miserable Thursday night football game last night.
yeah, man, I don't know what that was about, but I suppose Thursday is hard.
Overtime, 7 field goals in an overtime. Great.
Yeah, oof, brutal. And so here you have a scenario where the only star player on the field is energy and the dollar. Beyond that, so much weakness. And I'm sure there's pockets elsewhere, but now you have a scenario where, I mean, we talked about the 200-week moving average, which is a huge moving average where things start to really fall apart if you're below it. And small caps rejected the 200-week moving average from the underside this week. You have Qs confirming a breakdown of the 200-week moving average, and S&P's reapproaching. Like we thought maybe we were seeing some demand off of that level, but now that's in question again. And again, we're talking about the best performing index on the planet, the S&P. All these other areas still abysmal.
Horrible.
I mean, I suppose maybe we could talk about.
And that was another level that never had a failed breakdown. You take EFA, foreign developed, never got back above its bottom in July, but never reclaimed that level.
No. And it is interesting because, I know the topic du jour last week was that Credit Suisse, there was something wrong with Credit Suisse. And when you look at that, definitely bouncing hard versus European financials. But I guess I'm not ready to say we're out of the woods yet on something like
that. Yeah, this thing is it's a European bank, so it's clearly underperformed for the last decade plus. It's had a nice relative bounce here. Was that a rally because it was so insanely oversold, or is that, we'll find out.
Well, I think another interesting area that doesn't, I want to make sure that doesn't come across as a recommendation, is how well biotech has held up on a relative strength basis. So you got energy and biotech. Meanwhile, your quote unquote number one COVID vaccine provider, mRNA, looks like it's about to have some serious issues below 120. So it's really an interesting time because, right, you don't think of biotech as like a place that you should be. And again, not a recommendation, but it's really interesting to see biotech hold up.
Well, it certainly helped the Russell hold up.
Yes, that is true. Because there's about a bajillion biotech stocks out there.
In fact, I think they just IPO'd the bajillion and burst.
Yeah, bajillion. Yeah, bajillion has a lot of zeros.
Has a ton of zeros.
Yeah, it's pretty overwhelming to look at, really.
And that's what messes with the NYSE. That's why when you use your NYSE Brett, you have to back out because there's a bajillion of them.
Yeah, you got to back some of that out.
You don't want to over manipulate the data.
And so, really, in essence, this was a shot. This was a shot that demand had, that bears had, that failed this week. It is a logical place that you would expect to see some. Yes, the bulls to take. This would be a logical place to see demand show up heading into this week, and that appears to have failed. With us bumping up against the edge of our time, anything else you want to touch base on before we wrap this up and call it a podcast?
I will say that regarding Credit Suisse, we talk about rallies. Lehman Brothers was one that had been in a pretty big downtrend, not necessarily the type of downtrend that Credit Suisse has been, but in those final days, right, some pretty big rallies out of that stock as well. So I don't know if the Credit Suisse story is over or not. And that one moved quickly. I mean, it went in a couple of weeks, it went from, $14, which is a pretty healthy price, to 10 cents.
Right.
Suisse has been a little bit more of a, if something happens, maybe it's a little bit more obvious, but yeah.
Well, and I think
just failed. Yeah. Failed attempt for the fourth time this year from bulls.
Right. And that's what I would summarize for our clients is some risk taken on beginning of the week based on the price levels that we had. That failed. Stop losses are appropriate. Hitting the sell button is important. Cash is a position and will remain so until the correction is over, which we won't know when it's over until price confirms it's over. And for right now, the bearish thesis remains below 3667 on the S&P 500. And we remain below important equity levels on so many other things. It's risk off.
Yep.
All right, Ian, appreciate you. Appreciate you doing this with me. We're going to go hop on our market call with our teammates. Everyone out there, we appreciate you guys listening. If you give us a high ranking, that would be great. Helps us get the word out.
Have a great weekend, everyone.